Namaskara. Hello students. Welcome to our channel CA Made Easy. Grab your notebooks, get your calculators ready and settle in because today we're entering the final training arc for Chapter 4 Mathematics of Finance. This is part 4 of our Explainer series and today we're mastering the absolute ultimate moves of this topic. We're talking sinking funds, applications of leasing, and the valuation of bonds. We're going to break down these complex financial concepts using pure logic so you don't just memorize them, you truly understand them.
But before we really jump in, I need you to understand exactly what is at stake here. ध्यान से सुनिए दोस्तों. Listen to me very carefully, friends. Your business mathematics, logical reasoning, and statistics paper is a 100-mark objective exam, right? And the mathematics portion alone is 40 marks. Out of those 40 marks, this single chapter, time value of money, guarantees you 14 to 15 marks. Just let that sink in. Mastering what we discussed today is absolutely non-negotiable for clearing your CA foundation. So I need your absolute undivided focus for this entire session.
Okay, let's take a quick look at our study plan for today. First, sinking funds. Second, leasing and capital. Third, valuation of bonds. And finally, some essential calculator tricks. Let's dive into it. Section 1. Sinking funds, logic, and formulas. Okay, I want you to treat this first concept like you're building up power for a massive final attack in a video game. We are going to learn how to accumulate a huge sum of money by making smart, small, consistent moves. According to our ICI study material, a sinking fund is created for a specified purpose by way of a sequence of periodic payments over a time period at a specified interest rate. Now, what does that actually mean in plain English? Just think of it like a very powerful piggy bank. Suppose a company has issued debentures, and they know that exactly 10 years from today they need to pay back 50 lakh rupees. Instead of completely panicking in that 10th year, they start saving a little bit every single year. But, and this is key, they don't just keep it in a drawer. They invest it at a specific compound interest rate. Thoda thoda save karo or compound interest ka jadoo dekho. It's simply saving bit by bit to defeat a massive future expense. And here is the formula you're going to use for this. A equals P multiplied by ANI. Now, please do not let this mathematical notation intimidate you. A is just your huge target amount, the future value you ultimately want to reach. P is your periodic payment, meaning the small installment you pay every single year. And that ANI, that is simply the standard future value of an annuity regular formula. Yes, literally the exact same formula you already know. 1 plus I to the power of n minus 1 divided by I. A sinking fund is honestly just a future value annuity problem in disguise. So let's prove that by solving an actual problem straight from the Institute's material. Imagine I'm writing this out on a whiteboard for you. ICAI Example 35 asks, how much amount is required to be invested every year so as to accumulate 300,000 rupees at the end of 10 years if interest is compounded annually at 10%? All right, step 1, identify your target. Your A is 3 lakhs. Step 2, set your time N to 10 and your rate I to 10%, which is 0.10. Step 3, we just need to solve for P, the annual installment. We set up the equation. 300,000 equals P multiplied by the future value annuity factor for 10 years at 10%. Now, to solve this quickly, you need to calculate 1.10 to the power of 10. Pick up your standard calculators right now. Let's do this together, nice and slow. Type 1.10. Now, press the multiply button. Now, to get the power of 10, you only press the equals button n minus 1 times. So in this case, press equals exactly 9 times. Count with me. 1, 2, 3, 4, 5, 6, 7, 8, 9. Your screen should show 2.59374. Subtract 1, divide by 0.10, and you get your annuity factor of 15.9374. Finally, divide your massive target of 3 million rupees by this factor. Boom! Your answer is 18,823.64 rupees. Practice this trick until it's absolute muscle memory. It will literally save you whole minutes on the actual objective exam. Section 2. The applications of leasing and capital expenditure. Let's move along and see how this builds into our next core concept. We've mastered future value with sinking funds, right? Now we are going to completely reverse the timeline and look at the present as we dive into capital expenditure. What's really interesting here is the fundamental business dilemma it represents. Imagine you're starting a factory and you need a massive, super expensive piece of machinery. You generally have 2 choices. Choice 1, Buying. This is a capital expenditure, meaning a huge cash outflow today in anticipation of benefits over the next 10 or 20 years. Choice 2. Leasing. Instead of buying, you just rent it. You make periodic lease rental payments over time. To compare these two totally different timelines fairly, we cannot look at future money. We must drag all those future lease payments back to today's value using present value formulas. When evaluating these investment decisions, the ICAI study material gives us a golden rule. Artva Vigadea? Understood? The rule is always calculate the net present value, or NPV. You find the present value of all the cash you're going to save, and you subtract the cost of the machine today. If the NPV is greater than 0, accept the proposal. Why? Because it means the present value of your future savings is actually higher than what you are paying out of pocket today. It's just pure logical business sense. Let's actually apply this logic to a classic machine cost problem from the text. Suppose a machine costs 10,000 rupees today, but it reliably saves you 1,900 rupees in labor costs every single year for 7 years at a 10% discount rate. Okay, step 1, find the present value of an annuity regular of 1,900 for 7 years at 10%. Using the PV formula, those savings equal about 9,250 rupees in today's money. Step 2, compare this present value to the machine's cost. The savings are 9,250, but the machine costs 10,000. Step 3, make the decision. Think about it. You are spending 10,000 today to effectively save 9,250 today. That is a net loss of 750 rupees. So you reject this machine. Always discount future savings to today's value before making your choice. Section 3, Mastering Bond Valuation. Take a deep breath, stretch your neck out, because we are now entering the final and definitively heaviest topic of this chapter. This is a very serious exam concept, and examiners absolutely love testing it because it perfectly combines multiple time value concepts into one single problem. Let's just start with a simple definition. What exactly is a bond? A bond is a debt security where the issuer owes the holder a debt and is obliged to repay the principal and interest. When you buy a bond, you're essentially lending your hard-earned money to a company or to the government. In return, they make a strict legal promise to you, and this promise has 2 specific parts. First, they will pay you regular interest, usually every year. Second, at the end of the bond's life, they will return your original principal amount in full. So the absolutely crucial point here is understanding the dual nature of a bond's cash flows. Because you're receiving 2 completely different types of payments, valuing a bond today means doing 2 separate calculations and adding them together. The bond present value equals the present value of the regular interest payments, which is just a standard annuity regular calculation, plus the present value of the final principal repayment, which is just a single cash flow calculation. You discount both streams of income all the way back to year 0. Let's walk through ICAI example 40 slowly to see this in action. An investor wants to buy a 3 1,000 rupee par value bond that pays 10% nominal interest, but they require a 14% return. First, let's calculate the interest cash flow. 10% of 1,000 is 100 rupees every year for 3 years. The final year also returns the 1,000 rupee principal. To find the fair price today, we discount all of this at the required 14% rate. As you can see, we divide the year 100 rupees by 1.14. Year 2 is divided by 1.14 squared. Year 3 gets the 100 rupee interest and the 1,000 rupee principal, both discounted by 1.14 cubed. On your calculator, you can use the constant division trick for this. Type 1 divided by 1.14, hit equals for the first year factor, hit equals again for the second, and so on. Multiply those factors by the cash flows, add them all up, and you get exactly 907.125 rupees. That is the fair present price of the bond. Section 4, Sums and Final Exam Takeaways. We've covered some immense ground today. Now we're shifting into the summary phase. It's time to integrate all these ultimate moves you've just learned so you can walk into that exam hall with absolute confidence. And the flow chart from the Institute's material brilliantly illustrates exactly how everything is connected. Look at how it maps the root concept of annuities. Whether it's an annuity regular or due, it naturally branches off into applications. The future value concepts feed directly into sinking funds, where we accumulate money for tomorrow. The present value concepts feed directly into capital expenditure, leasing, and valuation of bonds, where we discount tomorrow's money back to today. Take a mental snapshot of this map. This is exactly how a CA thinks about money. Let me leave you with the absolute core survival strategies for this objective paper. Here are your golden rules. Number 1, sinking fund problems will always use the future value annuity formula. Number 2, leasing and bond valuation problems will always use the present value formula. Kabhi mix up mat karna. Literally never mix these up. And rule number 3, the classic trap they love to set. Always align N, which is your time, and I, your interest rate, to the conversion period. If compounding is monthly, divide I by 12 and multiply N by 12 before you even touch any formula. Okay, now it's time for a high-stakes challenge to wrap things up. This is MCQ 12 from your past papers. Listen closely. A sinking fund is created to redeem debentures worth 5 lakhs at the end of 25 years. How much provision needs to be made out of profits each year, provided sinking fund investments can earn interest at 4% per annum? I want you to identify the target, identify the time and rate, use the future value annuity formula, and use that Casio calculator shortcut we practiced today. Do not skip this. Work it out right now and drop your final answer in the comments below. Remember, understanding time value doesn't just pass exams, it is the exact same math the wealthiest investors use to build literal empires. Master this and you master money itself. Thank you for joining this explainer. Keep practicing, and I will see you in the next session.